banks, several of them were good, and those came out yesterday too. So
You know what time the bank statements came out?
I don't know. I'd have to look for it, but like JPM and all the big ones, like they came out very, and those came out yesterday too. So
You know what time? Okay. I don't think that the bank was a part of it because keep in mind it jumped at 8:30, and
Mhm.
any kind of announcement would have came out after 9:30.
Okay.
So I don't think that that factored in. I think it was purely just the because keep in mind I'll say it over and over again. The CPI is the strongest indicator for the markets. People wait, even if they're not trying to trade it. A lot of people don't know what we're doing. People just use it as the gauge, as this heartbeat monitor for the economy. And they start making all of their decisions. Corporations will make their budgets and their decisions. Banks are making their decisions on interest rates. And then the institutions are making their positions in the markets, their bond market, their yields, everything is based on that CPI. It's the strongest momentum that you're going to get out of all of them, even interest rates.
We saw that yesterday. I mean, it was great.
Yes. So that is the single reason why the CPI was so strong. And once again, that's why I said when I saw the PPI go up like that, I already knew the CPI was going to do the same thing because
And
the
this is
PPI
every month.
also jumped 400 points. Go ahead.
And this is every month.
Well, keep in mind, right now, this is the where everything is sitting and where the expectation is sitting. That's the reason why I've seen CPI reports that are as expected. Like it does exactly what everybody is expecting, and it may pop up 50 points to 100. Maybe it was a report that was leaked. So they just, they didn't nobody expected the markets to do anything other than what it did. But sometimes, and I always go back to this one, September 2022, the CPI dropped so much that the top 3 billionaires lost like $50 billion. And it went around the world and every market went red. Does anybody remember that back in 2022? Elon Musk, uh, Warren Buffett, I think the top five billionaires lost. And we're talking they lost the money within minutes. Jeff Bezos, um, Microsoft CEO, they all lost crazy amounts of money, net worth, because of that CPI report. And then it went around the world, and every market around the globe went negative because of that CPI report. So sometimes it can be really good, sometimes it can be really bad, sometimes it can affect the markets for a couple of hours, sometimes it'll affect the markets for a couple of days. But that's just proof to you that the CPI is the number one report that everybody looks for. So you need to keep it on your calendar because that is probably going to be one of your biggest trades for the month, especially when you're trying to get to your profit goal, your yearly profit goal. That's another one of those trades that can make up for anything that you lose in other economics and other economic events. If you're trading the other economic events and you got this potential market that might give you a couple of thousand, it'll make up for any losses you have. Between the CPI and the interest rates, those are the two that's going to move the markets the most. If people are expecting a drop, because I'm going to keep saying that word. What is people expecting? As long as the expectation is big, the trade's going to be big.
So, Aaron, I
Yes,
have
ma'am.
a question
Mm-hmm.
because this is where I'm not quite understanding. Um, so I know yesterday when we looked up the articles, we were saying that the expectation was for it to be higher, right, than previous. The forecast is either going to be the same or higher, correct?
Okay. Yeah.
But the number came in cooler. came came in cooler, right?
Okay.
And so even though our climate and what we are thinking about interest rates and things like that is going to help, with, like I had emailed you, that okay, so we are expecting that maybe we're going to hopefully get another interest rate cut, um, because of the current climate. But my problem is that the expectation was the same or greater, right? And then we got, looking at your course is saying, okay, everything is positive. So we thinking it's going to go up. But the actual number came in lower than expected. So that's what I'm not getting. Like, if I'm sitting at my computer and it's getting ready to be 8:30. Now I understand that, we have our other avenues that we can take after the fact if we didn't get it right or whatever. But today, yesterday, and with the PPI, the expectation is that it's either going to stay the same level, with the year over year, month over month, and then the monthly was supposed to be higher, but it
Okay.
actually came in lower.
Okay.
So we
I
don't
can,
know at 8:30 which way is gonna what that number is gonna the actual number is gonna be.
and you don't need to. I'm gonna explain why. Because if you go through the course, even the newer courses, I explain the same thing. You go through the course, you have three opportunities to trade it. Let me give it to you again. You got remember, they either get it right, they get it wrong, or they learn it late. And I'm gonna go through that first, and then I'm gonna go back to why the markets did what it did. I'm gonna explain everything in detail. So you don't have to get it right. I have made other contingencies if you get it wrong. If you get it wrong, you can get back into the trade.
Yeah, I
So
understand.
if you get it,
I understand the
I know.
contingency.
Yeah, exactly. So don't worry about if you get it wrong. That's a part of it. It's okay because you have two other chances that even if you get it wrong, you can get back in. But here's the thing. Let's go back over this trade, right? So let me ask you this question. Were people expecting the CPI to be bullish or bearish?
They was expecting it to be bullish.
Okay, was it bullish?
The CPI, let me see. I know the PPI was bearish. The CPI was bearish. Wait. Let me go back. Okay, USA, it was bearish. It came in at 0.2 instead of 0.3 forecast.
Let's go over it again. What did I tell you the market was going to do?
You
Let's
said it's
go.
going to be
Let's give you
bearish.
that. What did I say the markets were going to do?
Be bearish.
Because we
No, I'm
went over
sorry,
the
bullish, bullish,
analysis.
bullish. We said it was going to be bullish.
There we go. There we go. Because every metric that we looked up in the cheat sheet was bullish.
Right.
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 So guess what? We are expecting it to be bullish. Then we went out to the news articles, and they were expecting the same bullish announcement. Did we get a bullish announcement? Yes. It
We
may not have been the strength. The bullish sentiment may not have been the strength that people were expecting, but people were happy with the bullish seat with all the metrics being good,
So it's not
especially coming off.
basically the number. That's what you're saying. It's not the number.
Yes.
Because I'm
Now
looking at
let
the
me give you
number
the other.
saying the number is 0.2.
Don't sometimes that can factor in, sometimes it can't, and I'm going to tell you why. We got 400 points when it didn't meet the expectation. What do you think the markets would have done if it did? You would have got more than 400. Because the amount of expectation is the amount of market movement. We still got a bullish announcement. They still got what they expected. They just didn't get the level of expectation.
Got it. Okay. Now it makes
And that bullish announcement was enough, because what do I say about the CPI? They're building everything. The corporations are building their budgets. They're building their quarterly earnings targets. The banks are building their interest rates and their loans and their bonds. The institutions are building their portfolio and their allocations. All of it is based on that CPI report. So if it was bullish, now everybody can go in and put in bullish gold. So it was enough for people to accomplish what they wanted to accomplish.
okay. That makes better sense to me because I was just like I was saying, focusing on that actual number, not
No,
needing the forecast number.
only if it's it. Like I'll tell you something. Unemployment works like that.
Okay.
Unemployment works. Housing works like that. They go really on the number. How much did that number move? 0.3. It didn't move at all. There are some economic reports that really rely on the number being exactly what they expect. But the CPI is an overall. It's not targeting one specific thing. The CPI is this general sentiment of every economic event. So they don't go by just, they're not precise like that with the CPI. Interest rates, housing,
Please
those
stop
kind of things.
now.
Go ahead.
I'm sorry, I got to cut my put my phone on mute. That's my car.
No problem, no problem. But that's the difference between some economic reports that are very targeted on what the number is, how much did it move, they'll go by that. But when you're talking these general, like the confidence has so many other factors. So they're not going to really target the numbers itself. We just want to know the overall sentiment of the economy, the overall sentiment of the markets. So CPI and confidence, the CCI, both of those are very general. And I'm pretty sure there's some more general. One of the housing is very general, where they take in all the construction and so like I said, those general announcements are not as targeted. I hope that makes sense.
Perfect sense. Thank you.
And then the other thing is, like I said, sometimes the sentiment will be right, but the level of expectation will be wrong, and you'll still get whatever direction the sentiment is, you'll still get that direction. But the strength of that direction is going to be on how much expectation was met. And I'll give you an example. Let's go back to the interest rates last month. If Powell did not mention anything about 2025, what do you think that announcement would have done? Because every other metric was bullish. So if he never brought in the 2025, that market would have taken off strong, which is what we were expecting. But because he brought in this one little thing where it wasn't as expected, then the markets went the other direction. And it went the other direction strong because, once again, interest rates are one of those metrics where they're going to make all of their decisions, especially at the end of the year, as they're planning their entire 2025. So any information that came out on that last year, end of the year kind of interest rate announcement, they're gonna view it a lot stronger because they're planning out their entire 2025 budget, 2025 positions, portfolio, whatever it is. So those are kind of some of the things you got to factor in. Even where in the year are they making the announcement? It's really about sentiment. And I'm going to keep saying that over and over again, because that's really where it is. Expectation, sentiment. I'm getting you halfway there through the analysis, because other people are just flipping a coin on the, or don't even know that it's about the emotion. A lot of people are out there looking at the same analysis that you are, or looking at the echo, and they're just going by what the echo is. But you guys at least get a heads up of what the real numbers are, and you're able to compare it with the sentiment, because that's the real secret of the economic events. What is the emotion of the markets? What is the emotion of the economy? I'll give you another example. I think that was also 2022. And at the beginning of 2022, it might have been 2023. When do we have the Bankman? I know we had the Bankman at the end of the year, somewhere around November of the year. Was that 2022 or 2023 when we had the crypto exchange go belly up?
That was like September, October 2023 when it started, and then I think it kind of played out after that. Yeah.
Well, I think we went through it in 2023. I think it started in 2022. At the end of 2022 is when the actual, when everything was exposed.
Okay.
And the reason why I'm saying that, I might be wrong, but what I'm focusing on is the following year, in January and February of the following year. That's when all of the banks went belly up. Remember, there was a startup that went belly up. There was like 3 or 4 banks that went belly up.
That was
Does anybody
20.
remember that?
That was
Yeah,
when
the bank.
Silvergate and Silvergate Bank and all of that went down.
Exactly. And that was in 2023, right?
Definitely.
Exactly. So the actual Bankman thing happened at the end of 2022. And then the causal sequence, all of the banks that had all of their money tied into that, they almost went belly up. So remember this. When I was talking about some of the economic events around that time, everybody, all of the institutions, all of the survey companies, all of them were leaking the reports. And I even told you why, because when you start looking at the news, nobody was saying the word expected. Everybody was saying, here's what the report's going to be. Here's what the report's going to be. Here's what the report's going to be. And I told you why they were doing it, because we were at such a fragile time that if there was a really, really major announcement like the CPI or something like that, and people are scared of it, there's going to be a run on the bank. And we were in such a volatile time, very, very, very stressful time, that nobody wanted that to happen. So they were basically just giving the reports away because they didn't want anybody to get spooked and do a run on the bank. So those are the kind of things you have to really look at when you're looking at the economy and looking at the stock market. What is the sentiment? What are people going through? I hope that makes sense. Adding those factors in is really going to help you determine how people are going to react and where they are. And I'll tell you, and this is why I give you the movies and TV shows and documentaries. If you guys go back and watch Trading Places with Eddie Murphy, there's a sequence in there when the two brothers are trying to show him the stock market. And does anybody remember the scene? I know you got to probably be a little bit older to remember the scene, but Eddie Murphy picked up on it
Best
quick.
movie ever.
It's like, oh yeah, they're panicking. He was able to read the price action, not knowing anything about the stock market, and told them what was going to happen. Oh yeah, they're panicking, dude. Just wait. Blah, 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 blah. Because he understood it was sentiment. Because he's from the streets. He knows how everything works. It's about what people are going through.
Hey, Aaron, I would also. So one of the things I do like when you pull out these references and you get a chance to go back, because I mean that kind of theater helps you understand that stuff. I would tell somebody, go back and watch Trading Spaces 3 or 4 times, Trading Places, if you haven't seen it. And there are so many things you learn. Like, I didn't fully understand shorts until I understood what was happening with the citrus crop and all of that. There are a lot of things that you can
A
learn
lot.
about trading.
Yes, sir.
Oh, that's an excellent one. I have my girls watch it with me, and once you get past the comedy of it, because I'm trying to teach them trading stuff,
Yeah.
and it helped it click for them.
Perfect. That's the reason why I give you all of those TV shows, movies, because you're right. You can watch it the first time for the actual storyline, but there are so many references. And that's why I told you yesterday, every single person in this room needs to watch Landman. They explain the oil. He stands in the middle of a field talking to a lawyer who knows nothing about oil, and he tells her every single product on this planet is connected to oil.
And
I'm telling you.
he explained fracking in a way that I had never heard it.
Yes. Like you do sideways, you blast salt water in there and then separate it. I'm telling you,
Yeah.
that TV show explains oil. And there was another thing. He was sitting across from somebody. I can't have that expense. How about you go ahead and set up some wind turbines and I'll pay you for that?
Yeah.
What?
Yeah. Yeah.
Mm.
Yeah.
But I know they're getting these things from real life. I never even considered that. Like they have back end ways on how they can move money around and stay above the laws. And even that whole thing, there is no pump with the independence. There's no pump that is OSHA compliant. That has to be a real thing.
Oh yeah, for as long as those things have been around, for sure. And like, I picked up on that too. And it's like, I can't pay you the way you want, but let's do it this way. And
Let's
I'm
do it
like,
this way.
oh my god.
Oh man. Everybody in this room should watch Landman. It is now, first off, it's a good show. I'm cracking up. I kind of see because I'm telling you the producer and the writer
Yeah.
of this movie, he is flawless, guys. You can go back and watch every TV show this man has ever done, even a couple of the movies he's done. He has not lost yet. Every single thing this man has ever written is just gold, and especially his TV shows. Brilliant writer. Everything flows correctly. He makes sure he casts everybody really, really good. Everybody's acting. It's very natural. The story progresses. But once you get past all of the entertainment of it, if you really, really watch it, go back, references, and I'm going to give you the two most accurate, like everything in the workbook. And I'm going to add Landman to that list. So I'm going to give you three. Three of the most accurate shows on there is Landman is one. There's a TV show called Billions. Everybody should watch. And there's a third TV show, and don't go by the name. There's another TV show called Devils. It's a Canadian TV show with McDreamy from, can't remember his name, but it's such a good show. And I want to tell you why they call it Devils. Because first
Patrick
off,
Dempsey is you talking
Patrick
about.
Dempsey, Patrick
Mhm.
Dempsey, there it is. So here's the reason why they call it Devils. Now, the first thing I like about it is because they go through real events. They go through the 2008 crash. They go through the pandemic crash. That is a part of the storyline. And what they're doing is these are high-end investment firms. So they're literally showing you how they are profiting off of other people's misery. Even to a point, even crypto is also kind of permeated through the storyline. But they're showing you either how they're profiting off of it, and in some situations, they're creating the misery to be able to profit. That's the reason why the show is called Devils. It has nothing to do with spiritism or anything like that. And I think it would have done better with a better name. But the most accurate that I have seen is Devils, Billions, and Landman. Now, there's a lot of other documentaries that you're now like I'm watching a new one that I added. So even the documentaries are really good, giving you a really good idea on how everything works. Because the documentaries is showing you real life examples on what people are doing behind the scenes. If you want to learn market manipulation, you want to learn the kind of things that they're doing to screw you over, watch the documentaries. That's what that's for. But the three most accurate storylines that are fictional would be Landman for the oil, and then for the stock market, watch Billions and Devils. It's amazing the things you're going to learn from those shows. All right. All right, guys, we got about 20 minutes. Let's go. And we're going to do this quick because we got about three different events that we got to try to get to. We're going to do the initial job claims. I'm going to try to fit in the retail sales. And we're going to, both of those are at 8:30. And I'm going to try to fit in the home confidence index and I think that's the one. Remember I said that the housing has one that's kind of general? The home confidence index is what I'm talking about. That is such a general that factors in everything with the housing to get that home builder confidence index. All right. So let's get these three done. And then we're already live on YouTube. When we're done, I'll unplug, and then I'll take any final questions as we go into the 8:30. And hopefully we might. And what I'm hoping is going to happen. Here's what I'm hoping is going to happen. I'm hoping that this initial job claims is going to pair up with any leftover sentiment from the CPI. And once again, remember I said you got to think about what the emotion is, because people are already positive on that PPI. People are already positive on that CPI. So I'm hoping that if this initial job claims and even the retail sales, if they're both very bullish, we're going to be able to combine that with a little bit of that optimism coming off of the other two reports, and hopefully the markets will jump again. All right, so let me pull up the cheat sheet from the course and show you guys how to analyze it. And I'm going to reiterate it again, guys. I love this new format. I love the ability to really go over all of the information. I love the ability to analyze with you on the live. I love the ability to get off of the live and allow you guys to simulate and trade real money. Because if we keep doing this, it's what I told Lisa yesterday, if we keep doing this every week, every day, doing another eco event, every month, going over the same eco events, there's no way, if you're not participating, like I said, don't get off and then go watch Netflix. Don't go back to work. Take a little bit of time, trade, what we discussed, and let's see how it works out for you. Then we're going to come back in here, or we'll go to the student room, or come back the next day, and we'll go over any questions you have. And if we do this constantly over and over again, there is no way you're not going to progress. For those in simulation, you're trying to progress to the contract ladder. Those of you that are already in the contract ladder, we're trying to get you to be multifaceted with multiple eco events, which is just going to maximize your money and be able to meet your yearly profit target a lot faster and a lot quicker. All right, so we're going to go to the Cheetah Club again. And we're looking for initial job claims. Now, I make sure not to curate this. I don't go look this up, because I thought about doing that, because I do have this little thing about me that I have this thing about perfection, that I kind of want to go over it to make sure there's no problems. But I know this, and I want to have that realism. So I don't go curate this. I don't go look this up beforehand. I do this on the live, on the fly. When you're seeing this, you're seeing it for the first time. I'm seeing it for the first time, and I like it to keep it like that, because if something goes wrong, I would rather be able to show you how to fix it right here on the live. If something's not going the right way, I want it to be realistic. I don't want to have to curate it beforehand and already know the solution. I'd rather fix it right here on the fly to show you how you guys can do the same thing. So what we're going to do is, you guys already know how the cheat sheet works. For those of you that may be watching on YouTube or that may watch this later, you get this PDF, this workbook in the courses. And inside this is a cheat sheet that shows you step by step how to trade the economic reports. The major ones, the ones that really move the markets. So the way that we do this is, we're going to find all of the initial job claims. So I already see one hit here, jobless claims on the first one. So that's one.
No, we just see you if you're trying to show something.
Thank you, guys. I'm gonna get this right one day. I forget that I share and unshare sometimes. All right. So once again, here's the opportunity cheat sheet. We have the initial job claims here on the strong dollar. We keep going, and there's another one under quantitative easing. There's a second one here. Let me highlight it so you guys can see it. There's another jobless claims here. And let me say it again, guys. This week, we only got the jobless claims. Every other week, you'll get the unemployment rate. And it works the same way that I explained it earlier with the CPI, the PPI, the CPI, and the CCI. Once you analyze that, you know what's going to happen with all three of them. The same thing with all of the the jobless claim. Do you notice how the CCI and the PPI are together? Because it's the same information. That's the reason why these are jumbled the way that they are. See, the CPI and the PPI are together. There's a reason why I jumbled them the way that I do. All right, because if you analyze one, you're analyzing all of them. So if you analyze the jobless claims and there's a non-farm payroll or unemployment rate, guess what? You don't have to look it up again. You look it up one time and you can trade all three of those throughout the week. All right, so that's the second one, jobless claims here. Let's find another one. Here's another jobless claims on a quantitative tightening, decreased interest rates. Now, granted, we already know this works, right? We've been using this for the last 3 months. We used this a couple of days ago. So I already know this works, but I still want to look at the rest. All right, we have another one. Jobless claims. It's got to be one under oil. Here's jobless claims under oil. So that's 3. Let me see if there's any more. I think that might be it. All right, so that's it. We got 3 different ones. And like I said, I already know the one that works, the one that's been working for 2 months on us. So I know that this, technically, this can probably work out because I think we still have a strong dollar. U.S. goods in foreign markets, that's still good. U.S. producers are unable to compete with imports. We have used this in the past, which causes unemployment. I would have to look up unemployment, which is what we're going to do in a minute. So this might be an actual open road, but I'm going to stick with the one that I know is open because we've been using it for almost 2 months now, and none of the metrics have changed. And we literally looked it up 2 days ago with the PPI. So I know that this works. So let's go down to here. Decrease interest rates, lower interest rates, purchases, right? This is the beautiful part about this, guys. Once you look it up, you know it works. We literally looked this up 2 days ago. So all we got to do now is go under this because we looked this up, consumer spending more. Now we know that this first part is correct. All of this is correct. There is a decrease in interest rates. Lower interest rates incentivize borrowing. We know that borrowing is up. People are using the credit cards. People are getting car loans and home loans. And there are more homes and cars being bought, especially last month in December. We went out and looked up the metrics. So we know that all of this is correct. We just got to see if this is correct. Businesses expand, encouraging hiring. So let's go look this up. All right, I'm going to go out to my browser. Give me a second. Second. So now let's go through here, and we're basically looking up businesses expand and hire more. And we put in, well, let's put in December because that's really what this is for, December 2024. And this is the one thing I love about the new AI being built into Google. It'll spit the answer out. In December 2024, the US economy added 256 jobs. So that's more hiring, 250,000 more jobs. Now I'm going to put in 2025 just to see if it will give it to me. I don't think it does, but let's just make sure. Yeah, there's nothing for 2025 yet. 2 days ago, here we go. January labor market review. Let's go ahead and click on that. 6 days ago, I like this. Job reports for January 2025. Let's look that up. So let's see what we got. Get rid of some of this. All right, what is it saying? U.S. labor market was remarkably resilient in 2024. We already know that part. With the unemployment to job openings ratio remaining under 1 at 0.9, the labor shortage continues to dominate recruitment conversations. Labor shortage. For HR leaders, this means doubling down on retention strategies to secure their existing workforce. So everybody has a job. And we know that we looked this up months before where they say this is the strongest labor market in the last 50 years. Do not believe the echo on the news, because what they'll do is they're only going to give you the metric month to month. And that's not good enough. Believe me, there's a lot of people that's going to try to scare everybody by only showing them month over month. If there's 1 month where the labor fell down or unemployment increased, they're going to try to use that small little micro metric to trick everybody into thinking we're going into a recession. It's the number one thing they'll do to try to scare people. But we know better. We know that we're going to look for at least 3 months, 6 months, or see if we can figure out what the overall market is. And we already know the overall market is we have the strongest labor market in the last 50 years, since the 80s. So do not let the echo scare you as these people are giving you metrics month over month. We know that December was strong. They're letting us know that January is coming in just as strong. So what does that mean? Let's go back to our cheat sheet. Now, let's look up one more, because I keep telling you, don't ever go by one report. So let's look it up twice. We looked up 2024. All right, we got one article. And let's see what this one says. This is January 10th. This was about 6 days ago. The December employment situation released today by the U.S. Bureau of Labor Statistics indicates the total non-farm employment rose by, once again, 256,000 in December on a seasonally adjusted basis, which, while temporarily helped services employment increase by 5,300 jobs. The temporary agency penetration rate was 1.67 in December, unchanged from the revised 1.6 in November. The national unemployment rate was down slightly, unemployment rate down at 4.09 compared to a revised November rate of 4.23. So even the unemployment rate came down. Employment grew in all of 3 sectors. That's also bullish. The group with the largest gain was healthcare, by adding close to 70,000 jobs. Retail trade, obviously during the Christmas season, they went up about 43,000 jobs. Leisure and hospitality, there was probably a lot of end of the year vacations, 43,000 jobs. The declines in employment were in the manufacturing sector, 13,000 lost. Wholesale trade lost 3,500, and mining lost about 3,000. But so many jobs were added in the top sectors that it overshadowed the losses in the smaller sectors. So this is a bullish report. Labor is good. Labor is bullish. So now let's go back to our cheat sheet and see how we can analyze this. Give me a second. Let me share it. Now, let me say this again, guys. I do not want you to allow us going over this as a crutch. I am showing you how you can do it. And that's the reason why I'm not going to do this every single event. I'm not going to do this every single week. I'm going to give some time that you can do it. You're not going to come in here every single day. Oh, Aaron will research it for me. Aaron will give me the answer. I'm doing this to show you how it's done, but I'm not going to do this every single time. There's other information. We got to get back on our curriculum. But since this is the beginning of the year, this is the first time we're doing this, I don't mind doing this all this week. But do not think that this is going to be a crutch. Well, Aaron will just look it up for me.
Hey, Aaron,
Go ahead.
I have a question. When I analyze, I always go back 3 months. Is that good or bad?
You always go
For
back to what?
everything, I always go back 3 months prior. If I'm
That's
like
a
if
good
I'm
thing.
doing like what I'm doing, like if I'm doing initial job trade, I mean jobless claim, always go back 3 months. I saw that you only went back like a month, like December or something like that, if I'm not mistaken. So can I go all the way back 3 months to look for it, or just go back a
You
month or
you
two?
you can, and I love the fact that you brought it up. Do you want to know why I didn't? Because we have been consistently researching it in the live. So you guys
Mhm.
have been with me on the journey when we looked it up back in October, November. So I don't need to go back that far because we've already done it together over the
Yeah,
past 6 months.
correct.
But yes,
Okay.
I definitely agree that you should probably go back to make sure. And that's kind of what I said, that the echoes will try to give you that 1 month over 1 month over, month over month or year over year. I don't want you to gauge it by month over month because they'll trick you. So you should definitely be going back at least 3 months. And I'll tell you another way that that won't be a problem is because something that I didn't do, because I got to get to the rest of these reports, is I want you to pull it up on TradingView. I want you to look at the chart, and the chart itself will give you, the metric of how far back you want to go.
Oh, okay, good.
I
Good.
just can't do it right now because of time constraints.
Got you. Appreciate you.
But definitely go back at least 3 months. And even what I said, like what's the yearly? I don't even mind you going back over a year and just get the overall sentiment of what happened in the past year. And once again, you can do that with the chart on TradingView. I even showed you how to do it. If you cannot find the chart in TradingView, you can go to Google, put in tradingview.com and put in the name of the economic report. And it'll come up like the first or second result. If you want to find the actual chart and you can't find it in TradingView, go out to Google, type in tradingview.com, and then put in like interest rates, put in housing, put in CPI, CCI, whatever it is. And sure enough, your search results, the first or second one, will be the chart you're looking for.
Thank you.
You're welcome. All right, so we now come back here. We now have confirmed that businesses expand, encouraging hiring. There has been an increase in hiring. So we know that all of this is bullish. Decrease in interest rates, borrowing, people are using credit cards, people are using their credit lines. Remember, let's bring this into the businesses. Businesses are using more of their credit lines to be able to buy more raw materials. All right. They're making big purchases, houses and cars. That means that businesses are purchasing more equipment, more trucks, more factories. So everything is bullish. So now let's go out and see what the sentiment is. I usually start with Reuters, and I can put in initial job claims. Uh, 2025. Let's see if they have any articles. See, this is all last week. January 8th, that's for last week. I don't see anything for this week. Nothing for January. So what I'm going to do is I'm going to go to another platform. Let's try Yahoo Finance. Oh, I didn't do it. Give me a second. Did not copy. Initial jobs claims. Yeah, see, this is going back to 2024. And once again, January 8th. I don't see anything current. So let's go to let's put it unemployment. Let's not do initial job claims. Let's get general. Unemployment 2025. what you need to know to get hired. See, that's not it. 3 hours ago, here we go. Global unemployment is set to hold near record low. Thank you. I love it. Global unemployment is set to hold near historical low at 5%. And this was January 16th. This just came out today. 6 o'clock this morning. Love it. So if this doesn't give us confirmation that we don't just have a low unemployment rate, it's global. Every country is having, overall is having a really decent employment rate. So this is the confirmation we need to know the sentiment. Now, what I would like to do, give me a second. Few traders expect Wednesday's data to convince. What the heck just happened? Oh, I jumped to the next one. That's why. Few traders expect Wednesday's data to convince the Fed to cut its main interest rate at its meeting later this month, as it's done in 3 straight meetings since September. But economists and analysts say it could open the door for cuts later in the year, maybe even in March. So this is talking about the expectation of how the unemployment is going to affect the interest rates next week. So it may not affect next week's announcement, but they're saying like later on, maybe in March, we might actually get a rate cut. But I don't see any real sentiment on this. So what I'm going to do is I'm going to take this historic low. I'm going to put it back in Google. Two hours ago, inflation relief. 6 days ago, employment situation, unemployment forecast. That's October. The effect of the job market on the economy 3 days ago. Let's get that one. And 18 hours ago, economic news. So let's check these 3 out. See what we got. Reuters is telling me that I can't get it anymore. No problem. I already know a way around that. Give me a second. I'll come back to this one. The effect of the job market on the economy. In what proved to be the strongest month of 2024, the U.S. economy added more than 250 jobs. The unemployment rate declined modestly to 4.1. Markets initially react negatively to the surprisingly strong job report. So everything is bullish, but we're looking for the sentiment. Given recent jobless claims trends, there's no reason to expect employment numbers will worsen in any meaningful way anytime soon. There's no reason to expect that these numbers are going to go worse. That's the expectation. Everybody is expecting that even in the near future, we're going to have a very strong labor market. Now, think about this. This is letting us know not just what the current sentiment is, it's letting us know that people have an optimistic view for the future, letting you know how strong this is. What to expect going forward. Investors continue to closely track job data as an important economic indicator and a potential signal about Fed. Now, this is the beautiful part, is that this just disconnected. Pay attention to what this is. This just redirected our focus. We're not looking at interest rates being attached to consumer spending. We're not looking for, unemployment. We're not looking for unemployment to be attached to consumer spending. We're not looking for unemployment to be attached to trying to think of another correlated market. We're not looking for it to be attached to housing. We're not looking for it to be attached to anything else. This is telling us that they are connecting the labor market to the Fed announcement. Let me say it for you again, because your entire focus should now change. People are tying it to what is the Fed going to do. That is still the number one thing on people's mind. People have not vacated what Powell announced last month. And I'm telling you right now, if you keep watching these news articles, they're going to keep tying it into the interest rates, because people are thinking the same way that I am. The people in the know, the professionals in the know, they're looking at the same way that I am. So they know at some point that Powell is going to have to retract that statement. Everybody who knows what they're doing in the markets knows that it's not just going to be one rate cut in 2025. We're just trying to figure out when Powell is going to change his mind and regress. We know it's going to happen. We're just trying to figure out what metric is going to bring that back. Does this make sense? Do I need to explain it again?
Makes
People are not. Go ahead. Go ahead.
No, I was saying it makes sense.
All right, perfect. Thank you. So, like I said, we're still analyzing, coming off of the CPI, we're analyzing this job report, but I'm letting you know what they're connecting it to. They're not connecting it to the PPI and the CPI from the last 2 days. They're looking in the future, next week's Wednesday report, which we saw in the last article. And this just kind of confirms where their focus is and where the sentiment is. They're connecting it to the interest rate announcement either this Wednesday next week, or even all the way, which what they're really expecting, they're waiting for the rate cut to come, expecting the rate cut to come in March. So just keep that in mind, that even though it probably will benefit or find some connection to the PPI and CPI since it's so close, they're not looking at that. They're gonna base their sentiment, they're gonna base their market movements, they're gonna base everything on the optimism of interest rates being announced next week or in March. And the level of sentiment that you get on the trade is gonna be based on that. Because keep in mind, we're still looking for a report. We're still looking for some kind of announcement. So do you think that when they come out with that announcement and they mention the interest rates, that it's not going to affect that trade? That's what I mean. We're looking to see when they make that announcement, if you're watching Bloomberg, CNBC, whatever it is, if you're looking at Bloomberg.com, Wall Street Journal, Reuters, look at the article when the announcement comes out, because if they mention anything about interest rates, that is going to factor into the sentiment and the direction and the strength. All right, guys, I was only able to do one. We're already at 8:30. I'm sorry. I did not do time management again. I was trying to get out at 8:30. I wasn't able to do it. But I still want you guys to go ahead. I don't even have time to do the housing. We spent so much on this, but this was the most important one, because even if you didn't make the 8:30, you can still watch the 8:30 takeoff. Those of you that are simulating, those of you that want to trade for real, I wish I could have got out by 8:30. I wasn't able to, but we can still trade the 9:30 and the 10 o'clock. Just be mindful of the 10 o'clock. That housing consumer index might factor in. Try to be out of the markets at 10 o'clock, because we don't know we weren't able to look at it. Now, you guys can probably research it, because you got another hour and a half. So I would take the next hour and a half and see if you can analyze the housing confidence for 10 o'clock. And then either factor that into getting in at 10 or staying out of the markets if you don't know, or if it conflicts with the unemployment. All right. So I'm gonna get off answer any final questions. I really gotta set an alarm for like 8:20 so I can get you guys off of here in time. I really apologize.